Chris Ward joining us in studio today, founder and senior wealth advisor at Entry Point Wealth Management. Chris, great to have you here with us. Now, as we take a look at this market action, at the top of the show we were mixed. Now we're entirely in the red. Yeah. What are your thoughts on what we've been seeing over the last, let's call it 8 weeks or so, as we've been dealing with the situation in Iran, getting increased inflation numbers?
Exactly. Yeah. I mean, the last 8 weeks, tech stocks have dominated, right? The XLK is up 30% since March 31st. And so as an investor, we need to be invested in those markets and have positions. But at the same time, I think we're seeing a divergence. We're living in a world where inflation is high and we're trying to manage expenses and interest rates and everything that comes at consumers. But at the same time, Wall Street has a massive amount of momentum. And so it's the ability to digest some of these high interest rates and be able to continue to see the growth continue. You know, I'm looking forward this week, right? We have a massive opportunity on Wednesday afternoon to see that growth continue with NVIDIA's earnings.
And so as we look at NVIDIA, there was a guest on the prior program that said sort of the expectation from his viewpoint, some of the whispers he's hearing, is that they have to beat and raise by more than they did last quarter. And the raise last time was about 10.5% better than what was projected. Are you in that same camp that it can't just be good, it can't just be great, it has to be even better than last time's great?
Well, if you remember, the last time I was actually on around NVIDIA's earnings was the first time you and I spoke.
Yes, it was.
You know, it's an interesting thing. I read a report from Goldman over the weekend. They expect NVIDIA to beat earnings, right? I don't really call earnings announcements with specific companies, but the idea is to position yourself for that positive outcome. And there's just so much momentum in the technology space that I think we should expect those companies, not just NVIDIA, but other tech companies, to lead and carry forward the earnings announcements. They missed in January. So hopefully the guidance has put them in a position to where they can excel and give investors something to write home about.
So let's say we see another miss. We don't get what the street is looking for here. We don't get what Morgan Stanley and JP Morgan and several others are forecasting right now. If NVIDIA disappoints even slightly in this quarter, does it kill all of that momentum we've seen in tech of late, or is it possible for the rest of tech to ride on the earnings we've gotten from the other big names?
No, I think there's more momentum than just NVIDIA, right? I think you look at the SpaceX IPO on its way. You just mentioned the Anthropic IPO potentially. There's so much ingenuity coming through the system that I think if it's not in the next 4 to 6 weeks that we continue this rally, we pick it up midsummer or we pick it up into the fall. I will mention that if we do see negativity through the earnings season, right, we see higher interest rates, it makes investors pause on the valuations for companies. I recommend clients definitely branch out. Get yourself some energy exposure. Go buy XLE. Go buy some energy stocks. Make sure you have that bifurcated move environment, because if tech falls and the Iran war continues, now we're in an environment where energy prices stay high. That's profits for those companies. So you need to be on both sides of the table. And then the last thing that I do want to add as well is I'm working hard to really talk to clients about managing interest rate risk, right? We see the 10-year Treasury pushing 4.6. It's higher than it was Friday. It's in a one-way trend. And so if you're a client that's just invested in bonds and you just have run-of-the-mill aggregate bond market exposure, you need to branch out. You need to look at maybe some floating rate. Could be EFR, could be SRLN are two symbols to go take a look at to give yourself some divergence or some diversity, and also to reduce the risk of interest rates, reducing the principal in your bond portfolio.
Okay, so staying away from our traditional fixes, as you said, we are north of 4.6 right now. We're fast approaching 4.61. Actually, we're 0.01% away here. But as we look at that, and you want to stay in a floating rate to protect yourself, you also have energy as a hedge here. Are you looking at energy as a hedge because of geopolitics? Is it inflation protection, or confidence that just demand is simply going to stay strong even though we have elevated prices? I
think it's two reasons, right? First, as a consumer myself, I hate having to spend so much at the pump, right? I was here, I flew in today in Chicago. It's like $6. Mm-hmm. In Cincinnati, it's $4.80, right? So at least we don't have it as rough as you might have it. But as a consumer, it's on one hand trying to manage the inflation risk. The other side of it is definitely geopolitical. I don't see an easy resolution to the Iran conflict. So then you have to ask yourself, what does happen? And so those companies don't have to manage risks of handling rising prices, passing on prices to consumers, and how that affects their business. They're going to be able to insulate themselves, deliver the product, and in essence, actually make more the longer this thing continues to go on.
And the longer this thing continues to go on, and I have to sympathize with you over filling up my gas tank, because we have our other hosts are in New York. We interview so many people from New York, and I know they don't have cars. And I'm just here like, oh, it hurts me every single time we talk about gas prices. Each week hurts more and more. But as we look at this, and more people now saying, you know, we don't know where the end is. Before, people were pricing an end, and now it's just sort of, we hope it ends soon, or perhaps it goes through the summer. Let's say that happens. You've got energy as a hedge here. We know that we've seen the rate environment heavily in flux and seemingly moving higher, even with some down days. Where else are you seeing opportunities here, either in specific spaces, or, you know, we talk a lot about the cascade effects or the ripple effects we're going to see even after we get an ending. Where else do you see potential opportunities, or on the flip of that, where are you staying away from?
Exactly. Yeah. I mean, retail businesses, right? My wife and I are entrepreneurs, and we have some retail businesses. Being able to pass on cost to a consumer that's already dealing with high interest rates, right? I don't want to be the Fed president either in this environment. That's one thing I don't want to do. But you got the high interest rates, high gas prices, and now everything's getting more expensive. So if you're a company trying to pass on those costs to others, it gets really difficult. And if you can't pass on cost, that means your earnings go down. That means your stock price goes down. So I think it's really an interesting time. Not to say that this trend can't continue in technology. I'm not trying to say that, because I'm not going to fight the trend, because I'm a trend following investor. But we have to be prepared, right? And so we have a base case of how we see the economic environment. And yes, it's challenging. But at the same time, this is where Main Street does not equal Wall Street. And so some of this innovation and some of this AI adoption can definitely carry earnings to a higher level. So I think, you know, you kind of have to be ready for both outcomes. That's why we're positioned in technology and energy. We own both. And so you have to kind of understand what the opportunity might be.
Yeah, nimble is a word that keeps coming up in my conversations. You have to be nimble right now. You have to be paying attention to the headlines, as much as we don't like how much it's driving the markets. But I guess that'll bring me to my last question here. From your vantage point, are we still in fundamentally a bull market, or are we simply in a momentum-driven rally that's becoming increasingly dependent on a handful of names and some of the geopolitics?
Yeah, I'll answer that real easy, okay? What would the market be doing if we are not in this conflict in Iran? Right, we are going not to the moon, but we're in a strong bull market environment, and I think that, you know, politically, we're trying to get to lower interest rates, or we're trying to get to good tax policy that will stimulate the economy, and we've done that part of it, but we've kind of taken two steps back, right? Because now we have this Iran conflict to manage and try to figure out what we do, and that's what's setting us back with higher energy prices, higher inflation, potentially Fed policy that's not going to be accommodative to continue to allow that growth to continue.
Chris, really appreciate you joining us in studio today. Thanks for flying in for this one. Always more fun to have you here with us than opposed to on Zoom. Really appreciate it. And great talk, some great insight there from Chris Ward, founder of Entry Point Wealth Management.